Hi everyone, this is Allan Madan from Madan Chartered Accountant. For those of you who don't know me, I am a chartered accountant in the Mississauga and Toronto regions of Ontario, Canada. Today's webinar is about the 2019 tax changes for corporations. The webinar will be about 30 minutes in length, followed by a 15-minute session for Q&A. So let's begin, please. And if I haven't said so already, thank you for joining. I really do appreciate it. The first topic has to do with income splitting with family members. There have been major rule changes with respect to dividends paid to family members of an owner of a Canadian corporation. These rule changes are effective January 1st, 2018. In a nutshell, the general rule is now dividends paid to family members of an owner of a Canadian-controlled corporation are taxed at 43%. Now, there are four notable exceptions to this rule: working in the business, non-service business, investing in the business, and number 4 for retirees. So let's please go through these exceptions together. Exception number 1 deals with family members who are working in the business and are receiving dividends from the corporation. To qualify for this exception, the family member has to be 18 years or older, works at least 20 hours per week on average in the business in the year, or any of the 5 previous years. So long as the average of the hours worked in any 5 preceding years is 20 hours or more per week, then this exception will be met. The dividends paid to the family member must be reasonable, based on the experience level of the family member, the difficulty of the job. Any unreasonable amounts or excess amounts of dividends paid that aren't reasonable will be taxed at 43%. To back up the hours worked, the employer or the owner should prepare timesheets signed by the family members along with a job description. So if this exception is met, working in the business, then the family member receiving the dividends will be taxed at regular dividend rates and not the highest tax rate applicable to dividends for 43%. Let's look at the next exception for dividends paid to family members. This has to do with non-service businesses. So for example, if a family member is receiving a dividend from a non-service business, then that family member will be taxed at regular rates on the dividends received. The following criteria need to be met. Number 1, less than 90% of the business income of the corporation is from services in the last fiscal year. So right now we're in the 2019 fiscal year, so we would make reference to the 2018 fiscal year. The family member is 25 years or older. The family member owns at least 10% of the voting shares of the business and 10% of the value of the business. The corporation is not a professional corporation. So doctors, lawyers, accountants, and dentists, you're out of luck. And finally, less than 10% of the corporation's income is from a related business, like a holding company. Let's look at an example. This is example number 1, an exception for a non-service business. You'll see on the right-hand side a diagram of an operating company, which is a Canadian-controlled corporation. X and Y, represented by the orange circles, are married. They are they're older than 25. X owns 50 common shares in OpCo, which are voting. Y owns 50 preferred shares in OpCo, which are non-voting. That distinction is important. OpCo is in the business of retail. $50,000 of dividends were paid to X and Y in the year by OpCo. So the question is, are the dividends paid to Y from OpCo treated as regular dividends, or will they be taxed at the highest rate of 43%? Is this exception met? So the result, the dividend paid to Y does not meet the exception because Y doesn't own at least 10% of the voting shares. and at least 10% of the value of the business. Remember, Y owns 50 preferred shares that are non-voting. As a result, the dividend received by Y will be taxed at 43%. Let's look at another example. Example 2. This is again relating to a non-service business. This diagram is a little bit different. We have a family trust represented by the purple triangle owning the shares of OPCO. OPCO is a Canadian corporation, and like in the previous example, we're assuming it's in the retail business. The beneficiaries of OPCO are X and Y. X and Y are married. They're over 25 years of age, and they are beneficiaries of the family trust. $50,000 of dividends are paid from OPCO to X and Y through the family trust. So again, the question is, are the dividends paid to Y treated as regular dividends, or will they be taxed at the highest rate applicable to dividends of 43%? The answer is Y does not own shares directly in OPCO, so the dividends paid to Y will be taxed at 43%. Remember, Y is just a beneficiary of the trust, not a direct shareholder of OPCO. The next exception for family members who are receiving dividends from a corporation in Canada has to do with investing in the business. So I think let's look at an example. It'll be much easier to understand. In this diagram, we have an operating company. The daughter is the founder of the business and she's running the business. She is the common shareholder. Her mom was nice enough to inject startup capital into OPCO of $100,000. Okay. So let's look at the criteria. Is the mom older than 25 years? Yes. Is she investing in the business, and is that a substantial amount? Yes. Is the rate of return reasonable? Yes. Okay. So mom is older than 25. She's bought preferred shares for $100,000 in her daughter's business, and the dividend she's receiving is 10%. That's reasonable compared to market rate investments, which yield approximately 8% to 12%. So the result is the dividends paid to mom will be taxed normally. The exception has been met. Retirees. Dividends paid to shareholders of a spouse where the spouse is 65 years or older is not subject to the high tax rules. They're treated as regular dividends. So let's look at this diagram. In this diagram, we have an operating company that is owned by a husband and a wife. In this example, I'm assuming that the husband is the principal operator of the business and the wife is a silent partner. The wife is 65 years of age, and so dividends paid to her because she's 65 would be taxed as regular dividends. And the Government of Canada did this on purpose as not to harm retirees with high tax dividends. The next subject has to do with the lifetime capital gains exemption. Let me start with explaining what the lifetime capital gains exemption is. If you are a Canadian resident and you sell shares of a Canadian-controlled private corporation, you can receive up to $866,000 of capital gains realized on the sale of those shares tax-free. That's a huge incentive for Canadian investors to start businesses in Canada, which is why this exemption is available in the first place. Now, beneficiaries of a trust, as you'll see in the diagram here, can also claim the lifetime capital gains exemption. The fear was that the Government of Canada would no longer allow beneficiaries of a trust to claim the lifetime capital gains exemption on the sale of shares. However, due to the uproar and anger of the business community, the government backed off the proposals and things are normal as before, meaning that X and Y in this example, beneficiaries of a trust, can claim the lifetime capital gains exemption when the family trust sells the shares of the operating company. Now, 3 criteria must be met. Number 1, at the time of the sale, 90% of the assets must be used by OpCo in carrying on an active business in Canada. At least 50% of OpCo's assets must have been used in an active business throughout the 2 years preceding the sale. And in the 2 years prior to the sale, the shares must not have been owned by anyone other than the seller or persons related to the seller. Let's move to the next slide here. So the other changes that the Government of Canada announced relate to increasing capital cost allowance. Capital cost allowance is the tax term for tax depreciation, which is a deductible expense. The rates have increased because the Government of Canada reacted to the drastic tax reductions in the US provided by President Trump. Here I have a chart. In this chart, I'm illustrating in the first column the asset type. The second column is the old capital cost allowance rate. The third column shows the new capital cost allowance rate after the changes for the first year. And the last column shows the new capital cost allowance rate for the second year onward. So let's just pick a couple of examples. Manufacturing equipment, the old rate, 25% in the first year. The new rate, 100% write-off in the first year of purchase. How about computer software? 50% is the old rate. The new rate is 100% write-off for computer software in the year of purchase. The small business deduction. There have been changes to the small business deduction. Specifically, the Government of Canada was very upset that small business owners were gaming the system. They were keeping as much as possible in the corporate bank account and corporate investments and paying a minimal salary or a minimal dividend to themselves. They are taking advantage of a tax deferral strategy, earning lots and lots of passive investment income inside their corporation. The Government of Canada found this offensive, and they are now penalizing small business owners by reducing the small business deduction limit if passive investment income is earned over a certain amount. For those of you who don't know what the small business deduction is, well, it means that the first $500,000 of taxable income earned by a Canadian-controlled private corporation will be taxed at only 12.5%. That's the combined federal and provincial rate if you're in the province of Ontario. So let's look at these bullet points here, and then we'll look at an example. The small business deduction limit is reduced if a corporation earns passive investment income over $50,000 in the year. Specifically, the small business deduction limit is reduced by $5 for every $1 of passive investment income over and above $50,000. So if you're a small corporation and not really earning a lot of passive investment income, this is not going to impact your corporation. The SBD is completely eliminated if $150,000 of passive income is earned in the year by the corporation. Passive income includes capital gains, interest, rents, portfolio dividends, and royalties. Let's look at an example. I like to pick on doctors. So ABC Medical Professional Corporation has taxable income of $400,000. Included in the corporation's taxable income is $110,000 of interest and rents. Not bad. In this example, the small business deduction limit will be reduced by $300,000, and I've shown the math to the right side. As a result, the new small business deduction limit will be $100,000. So what does this mean? The result is that of the $400,000, $100,000 of taxable income will be taxed at 13.5%. The remainder, $300,000 of taxable income, will be taxed at 26.5%. That's a huge tax increase. So you can see how passive income earned by a corporation can negatively impact its tax rate. Here's a chart that I'm illustrating the effect of passive income on the SBD limit. The first column shows the quantity or amount of passive income earned in the year. The second column shows the reduction to the small business limit. And the third column shows what's left over after the reduction. So let's look at a particular line item. I'm looking at row 3. In row 3, you'll see that $90,000 of passive investment income is earned. As a result, the small business deduction limit is reduced by $200,000. What's left is $300,000. The new small business deduction changes are effective for taxation years beginning on or after January 1st, 2019. But the 2019 small business deduction limit is based on the passive investment income earned in the 2018 tax year. Ontario, fortunately, will not be enacting changes to the SBD for passive income earned. All other provinces are. I often get asked by clients, Allan, how do I get around these rules? And sometimes it's difficult to outsmart the system. So let's take an example here. In this example, and I'm looking at the right-hand side, we have Corporation C and Corporation D. Corporation C and D are both controlled by the same person or same group of persons. D earns passive investment income. C carries on an active business. Because the two corporations are associated, C is associated to D, the passive investment income earned by D will impact the small business deduction limit of C. In other words, the $50,000 passive income limit also has to be shared among associated corporations. So you can't set up another corp thinking that you can get away with not impacting your small business deduction limit. Here's another anti-avoidance rule that the government put in place. In this example, Husband Inc. has incorporated a company H Inc. Wife has incorporated a company called W Inc. Husband Inc. makes a loan at a prescribed rate of interest to Wife Inc. 2%. In the year, the investment generated passive income for $80,000 for Wife Inc. Because husband controls H Inc. and because wife controls W Inc., and because they're both related, husband and wife, the $80,000 of passive investment income of W Inc. will reduce the small business deduction limit of H Inc. In fact, the small business deduction limit of Husband Corp will be reduced by $150,000. The next slide has to do with refundable dividend tax on hand. This has also been impacted severely because of the changes that the Liberal government has introduced. No bias there. What is refundable dividend tax on hand? Refundable dividend tax on hand is applicable to income earned from passive investments held in a private Canadian corporation. Passive income, you see, is taxed at a higher rate than active business income, about 50%. And a portion of that higher tax is refunded to the corporation when it pays taxable dividends to its shareholders. The refund that the corporation receives from the RDTOH account is at a rate of 38 cents for every $1 of taxable dividends paid. Now we need to look at the concept of eligible dividends and ineligible dividends to understand how these dividends impact the RDTOH account and ultimately the corporate tax refund that could be received. Eligible dividends are paid from active business income taxed at the general corporate rate. What that means is eligible dividends are paid from taxable income in excess of $500,000 earned by the corporation. Non-eligible dividends are generally paid from active business income taxed at the small business rate, so from taxable income and profits below $500,000. Under the old rules, both eligible and ineligible dividends distributed to shareholders created a corporate tax refund from the RDTOH account. Under the new rules, only eligible dividends distributed to shareholders will create a corporate tax refund from the RDTOH account. What does this mean? The result is for small businesses earning less than $500,000 a year in taxable income and also earning passive income, the effective tax rate has just gone up dramatically on passive investment income. That's because these corporations will no longer get corporate tax refunds from the RDTOH account. This is akin to double taxation. The last slide has to do with the corporate tax rates, and I've demonstrated the small business rate among all of the provinces, as well as the tax rate applicable to investments. I've provided this chart for reference, and you can please look at it at your leisure. I'd now like to turn it over to Q&A. Any questions? I believe we went through the material pretty quickly. So if there's a question, I'd really appreciate if you could type it into the chat window, and I will answer your questions for the next 15-20 minutes. Someone has asked, will you be able to share the slides afterwards? Yes, I will. The recording will be available, as will the slides. Anyone have a question, please feel free to type it in the chat window. So the next question to ask is, my corporation is inside a family trust. Okay, because your corporation sits inside a family trust, what I think you mean to say is the corporation is owned by a family trust and there's probably beneficiaries of a trust. The beneficiaries, unless they're actively participating in the corporation, like working 20 hours consistently per week, they can't receive dividends anymore. And if they do get dividends paid to them, those dividends will be taxed at a rate of 43%. Presumably, you also have a beneficiary corporation. Dividends can be paid from the OpCo through to the trust to the beneficiary corporation, still tax-free. That has not changed. Any other questions that any of the attendees have, please feel free to ask me and I will do my best to answer. The next question I have is, can you let us know how we should be restructuring or making changes for this year? That's a good question. When compensation planning for dividends versus salary, we now have to examine whether the shareholders are in fact actively working in the business. And based on that, we can make a determination if dividends can be paid to those family members. The second point I would add is the timing of capital gains and interest in any other type of investment income. You want to make sure your corporation doesn't earn more than $50,000 of passive investment income in the year. So you'll have to time your gains and income inclusions accordingly. In terms of family trust planning, I still think family trusts are a great way to minimize estate taxes, but unfortunately it's difficult to income split via dividends through the trust anymore. The other question I have asked is, there's been many changes to the corporate tax rates, but if I pay myself a dividend, is that taxed now? Dividends have always been subject to taxation. The first $35,000 of dividends received are tax-free, providing that you have no other source of income in the year. The next question I have is, the corporation with passive rental income, corp tax, 12.5%. Well, if it's a rental income earned by a Canadian-controlled private corporation, the tax rate is effectively closer to 50% on the net rental profits. That's revenues minus expenses. The advantage of dividends to family members is now non-existent. because it's very hard to argue that these family members are working at least 20 hours per week consistently in the business if it's a small rental operation. So they really can't receive dividends anymore. Well, and if they do, then those dividends will be taxed at 43%. The other question I have is, my corporation has made an investment of $25,000 in a partnership. They're expected to go public next year, so the investment may yield a good return. That's good. Would this increase the value of the shares being considered passive income for the corp? It's not necessarily the value of the shares, but what's the actual gain that the corporation is going to realize upon exiting. If the gain is more than $50,000 in the year earned by the corporation, then the small business deduction limit of that corporation will be reduced for the year. The next question I have is, I want to purchase a car and rent it to individuals. Is this a non-service business example? Good question. I don't know the answer off the top of my head if a car leasing business is passive or active. I'd have to look into that, and send me an email, please, separately after this webinar, and I will answer. Another individual asks, is the first $35,000 of dividends paid out to a non-voting shareholder still tax-free? Yes, providing that that individual shareholder has no other source of income. Please do note that to receive those dividends, that individual has to either be a retiree, invested substantially in the business, or actively working in the business at least 20 hours per week on average. The other question I have is, real estate development considered passive or active? Real estate development projects are active income, active business income, not passive. The next question posed is, if I'm in a consulting firm, can I still have my wife as an employee that does general admin for 20 hours per week and have an existing full-time job? Yes, she'll be an awfully hard worker, but that's still possible. A job description needs to be prepared along with timesheets, and reasonable dividends can be paid to your spouse if she is a shareholder, providing that she's working on average 20 hours per week. So for an admin person, if I was to ballpark it, somewhere between $35,000 to $50,000 in dividends a year if they're full-time would be reasonable. Cut that in half if they're working part-time or 20 hours a week. The next question I have is, Allan, you mentioned that the first $35,000 of dividends are tax-free, providing that you have no other source of personal income. My corporation pays me both salary and dividends. Does this preclude me from receiving tax-free dividends? So to answer that, what I'll say is that, as a general estimate, reduce the amount of dividends that you can receive tax-free by the amount of the salary paid for you in the year. Another person writes, hey, I thought it was $42,000 in dividends paid that were tax-free. Used to be that way, but it's been gradually being decreased. So in the province of Ontario, it's $35,000. I'll take a few more questions for the next 5 minutes before we cap the Q&A. If I wasn't able to answer your question, please email me. My email address is amadan@madanca.com. If our business is needing a new vehicle for this year, and your first side suggests that it's now better to buy a truck and claim the 45% write-off. When I was referring to trucks, let me go to that slide here. I'm looking at the chart. So what I believe they're referring to here is work trucks that are used for hauling goods or for transportation of some type of goods, not a passenger vehicle that's just used to move you, like an F-150 or a smaller truck where it's not used to really haul goods or used as a work truck. Otherwise, for regular passenger vehicles, including trucks not used for hauling goods or not used as a work truck, the depreciation rate remains the same, 30%. Or in other words, 15% in the year of acquisition and 30% for each year thereafter until the vehicle is completely depreciated. Any other questions? Okay, I think that concludes the, one last question and then we'll close out the webinar. When buying a property for a business, whether it's an office or rental property, is it better to pay all cash or is it better to mortgage? In terms of how much I can write off, well, I'm of the opinion that you should always get leverage, meaning getting a mortgage, because first of all, you're going to increase your return on investment. And in addition, the interest paid on the mortgage for a rental property, whether it's a residential rental property or an office unit or building, the interest is tax deductible. Well, thank you so much for participating in today's webinar. Thank you so much, and you have yourselves a wonderful day.